I think we will get started, and I'd like to welcome everyone to the May discussion group meeting of CIM MES. I'm Jackie Allison, Chair of the Management and Economic Society of CIM, and I'm very glad to have with me today Alan Smith of HSBC and Andy Reynolds of Inspire Resources, Inc. And I'll take this opportunity to thank our sponsor, Schulich School of Business Executive Education Center. One housekeeping item, I'd like to ask you all to use the Q&A function at the bottom of the screen to post your questions, which will be addressed after we have our presentation. Today's format is a little different from previous ones in that we have two speakers. And so it's a two-part presentation, and it's my pleasure now to introduce our two speakers, starting with Alan Smith, who will be our first speaker. Alan is Senior Advisor, Climate and ESG Risk Management at HSBC Group. He is also an advisor to the Secretariat of the Coalition for Climate Resilient Investment, a flagship COP26 initiative. Alan has worked with HSBC for 26 years in a variety of senior finance, investment management, risk and capital management roles in London and in Saudi Arabia, and is a fellow of the Institute of Chartered Accountants. Our second speaker will be Andy Reynolds. He is president of Inspire Resources, Inc. Andy is he's a president of Inspire Resources, which is a Canadian social enterprise mining company, which is deploying a new business model, Mineral Impulse, for integrating natural resource projects into community economic development plans. His experience includes almost a decade managing resource sector research and development in Canadian government labs and several years consulting to mining companies on innovation partnerships. This follows a 23-year career as a marine engineer officer in the UK's Royal Navy. And he is a UK chartered engineer and a professional engineer in British Columbia. And with that, I will hand it over to our first speaker, Alan, all yours.
Thank you, Jackie. And if you guys can allow me to share, perfect. Thank you very much. And thank you, everyone. And again, a real pleasure and privilege to be speaking to you. And indeed, in what is really genuinely a transatlantic discussion. I am originally from the Caribbean, but actually I'm based here in London, in England. And I think, Andy, you hail from England or now in BC. So we're definitely a global discussion, and Crystal Benjamin, who you can see there on the screen, who's based in Trinidad, has actually helped me to pull together the presentation today. And we'll be focusing on, in the context of climate change and our transition journey, focusing on the mining sector and how important it is and central it is to our transition to a net zero world. And then also looking at how some of the issues that are coming up that we need to be thinking even as we start that journey. I'll be looking and doing that, taking some case studies from actual live disclosures that a number of banks, including ourselves at HSBC, have recently published. Okay, I'm just trying to get my screen share. And what I want to cover is actually re-emphasizing climate change and the mining sector, looking at some of those important first principles that are shaping it, looking at, again, two case studies, what we of HSBC have done recently in disclosing around the mining sector, and also another of our international peers, Standard Charter, to bring out some of the nuances that we're seeing, and then leaving you with a couple of key themes and reflections as you as leaders of the mining sector will have to take forward. Afterwards, I'll send the slides to share with you guys. I'd like to actually start and reiterate why we're on this journey to net zero and why the mining sector is going to have such a big thing. If you remember the Paris Accord going back to 2015, with emissions, we're currently on a trajectory of somewhere between 3 and 4 degrees if we continue with that, and we have to get to 1.5 degrees. Some people kind of say it's 1.5 to stay alive. Whatever your mantra, getting to net zero means that so that we keep average temperature rises to 1.5 degrees by 2050 is going to cause for a collective effort. And one of the key players within that is going to be the mining sector. And that actually was reiterated just last week by the IEA, who came out with what was, I think, a groundbreaking report on net zero for by 2050, a roadmap for the global energy sector. And I just even have a few reflections on this slide to show what a profound implication it will have for everyone, and in particular the mining sector. So this kind of schematic here maps out almost decade by decade from now right through to 2050 of that vision of how we'll have to get to net zero. And if you look at so many of the blocks within there, it's going to have implications for mining. So whether it's phasing out of kind of coal in advanced economies by 2030, whether it's 60% of global car sales being electric by 2030, whether it's kind of by 2045, 50% of heating demand met by heating pumps, or all of these things. When we think of the underlying implications that that's going to mean for us to get there, it's going to play out for profound implications for the mining sector. And even taking that IEA report to another of the graphs within there, this is how they're seeing critical demand and supply changing over that period between now and 2050. And that kind of bar chart in the middle about critical mineral demand, about all of, whether it's lithium, whether it's copper, whether it's nickel, is showing how much this groundbreaking change and essential change to get us to net zero is going to have for the mining sector. And again, making us reflect on how profoundly important a role the sector will have in leading and helping to shape and engaging on that. From us and from our side and from a financial institution, there are lots of things that are driving that. There is the shareholder imperative, there's a board imperative, there's a regulatory imperative. We here as a global bank, lead regulated by the Bank of England, are looking at it in 4 building block pillars: how we govern ourselves, how we manage our risks, how we look at the scenario analyses around how we think about how the world may change as we get to net zero, and how we disclose it. All of those are fundamentally changing how we look at the world in anticipation and preparation for net zero, how we look at and engage with our clients and our counterparties, and within that, how we engage with the mining sector, who are one of the key transition sectors. But this building block of governance, risk management, scenario analysis, disclosures is the lens that we're increasingly looking at so many of our customers, and in particular at the mining sector. Because the transition to a low carbon economy is throwing up risks, and a risk taxonomy that all of us are having to face. Broadly speaking, climate risk breaks down into 2 types of risk within a taxonomy. Transition risks, how as policy and regulation and technology and consumer preferences change as we transition to the low carbon economy, that creates very profound transition risk. And also physical risk, as the changed, as there's more CO2 and other in the atmosphere, and as weather patterns change and as the climate changes, that is playing out into real physical risk. The key thing about this taxonomy is that even as we've thought about it from a financial sector corporate lens, I would argue, and maybe even throw and challenge for you, and even as we get in the Q&A, that this taxonomy is also yours, that as a mining sector, that even as you look at it and how you break down your risk and analyze the risks that you have to face as leaders within the mining sector, that this taxonomy applies to you as well as you manage the transition. One key tool that we use, and again, I think also applies to the sector, is how you use scenarios. Everything about climate change, arguably, is what happens between now and 2050, that we're taking and informing our decisions about how we need to act and change our business models and manage our risks with an outcome that ensures that we get to 1.5 degrees by 2050, that we keep the average temperature rises. And from our perspective, we are using 3 broad scenarios, as are many financial institutions. We have an early policy action scenario that we actually coherently from now are taking all of the collective policy actions that get us there. Or we have what we call a late policy action scenario, that we kind of don't do too much in the next decade, and that then by 2030, we really have to act urgently and in a disruptive way to make sure that we hit net zero by 2050, or that actually there's not much more policy changes from now, what we call a hothouse world, that we actually continue on that trajectory and don't get to a net zero world. These three scenarios are important narratives because increasingly these are some variation thereof of how financial institutions or other players in the economy are looking at how they manage the risk, but also how they analyze clients and counterparties. So for example, these will be scenarios that banks are using to inform how they look at counterparties and have their discussions with clients within the sector. And that has come in not just from a risk management perspective, but because corporations and financial institutions now have higher disclosure requirements around that. There's something called the Task Force for Climate Related Financial Disclosures, TCFD, which are driving greater prescription about what needs to be disclosed around how firms are preparing for and addressing climate risk. They have it under the headings of governance, strategy, risk management, the metrics that you use to assess those exposures, and again, the scenario analysis that you're using to tell the insights from now. Why this is important is because, as you come on to the next slide, is that this is beginning to tell some of the stories from a financial institution on what are viewed as the high-risk transition sectors, of which the mining sector is one. So if I go next I'm going starting with a case study from us at HSBC. This extract here is coming directly from our annual report and accounts for 2020, which we published a couple of months ago. And this one here takes the 6 high-risk sectors, and if you note on it, and these high-risk sectors are prescribed by the TCFD. So this isn't kind of firms picking on mining or picking on chemicals. There's a degree of prescription here. But if you look at that, we begin to look at our exposures to the sector. And firms therefore are beginning to think of what is their risk appetite for the sector. But most importantly, beginning to have the questions around how is the sector preparing. So there's we are going through what we transition questionnaires, where we're sitting down, engaging with our counterparties, in particular the mining sector, as well as the other ones, and saying, do you have a board approved policy and a management action plan that's executable to getting you towards there? It'd be interesting to hear whether you already engaging with your banks there. But as you can see, we are engaging and getting feedback and intelligence, which at this stage is still largely qualitative, but is going to move quite quickly to quantitative insights as that engagement comes. So this is one aspect of the disclosure. Another one is actually talking about how we believe it will impact the mining sector. You know, talking about the emissions of the sector, the need for the sector to, in particularly high-risk areas such as coal, which will have a focus around how we need to engage, the ways in which the sector can start looking at transition around green technologies and changing mining extraction models. And Andy later is going to elaborate on that in his presentation. Then looking also at again, some of the actions and some that we begin to be expecting to see mining clients doing. And also looking at the way, by way of an example loan here, of how looking at a sustainability-linked loan with a steel manufacturer, how we have begun to engage with clients as we seek to help to provide solutions around transition. Another aspect linking to what I said about the scenarios is this is actually how we, having run a first cut scenario on the sector, look at begin to look at the impacts, breaking it out between coal, between energy transition minerals, between steel production and other minerals, looking at how those scenarios that I talked about, orderly and disorderly, who's more impacted than others, and what are some of the potential actions that may be necessary. At this early stage, this is very much a narrative and a storytelling, but actually increasingly these will be forming parts of discussions with clients. But also on the other hand, something which mining sectors should be using from your side to proactively think about engaging and telling the story as you know it in the other direction. Gave those examples from ourselves, which is very much focusing on transition risk, actually taken as a very another good example, some from Standard Chartered in terms of their disclosures, where they actually focused on the physical risk aspects of climate as it relates to the sector, where they're actually, in looking at their exposures, talked about, did their scenario analysis to look at how mining clients may be, and those mining clients that may be more exposed to water stress, and then using particular analytics. So there in this particular case, S&P's true cost methodology, using that to locate, using to look at who may be vulnerable, and then increasingly using that to look at some of the discussions that they will have with their clients. And then looking at some of the physical adaptation, mitigation techniques that they'll expect to be seeing and expecting to be having with mining clients as they look at it. And also, again, taken from their disclosures, looking at the way, in this case, again, focusing on thermal coal, which is a really important aspect of the mining sector engagement, looking at how they, over time between now and 2030, will calibrate or recalibrate their risk appetite. The key messages that I want to give from those is the way in which, as we are having greater market disclosure requirements, and even as we are having to more actively manage the risks around climate, that the mining sector is very much upfront and central about how we're having to disclose and having some of the discussions. It's meaning that at a board level, we're having to ask important questions around brand, ambition, targets, aligning the business models. Again, these questions here, while we ask them as financial sector customers, I think equally apply to the kind of questions that we'd expect mining clients to be asking. And it's not just brand, ambition, business model, it's also about risk management and accountability and culture and training. And it's not just those kind of questions. McKinsey's quite recently actually put out a report very specifically focusing on the mining sector, and from their view, they're kind of saying that there are kind of three things that every mining CEO should know and ask on. Which are the assets that are most at risk from physical climate change? How will decarbonization shift the demand for key minerals? And you saw that chart earlier about how the IEA is forecasting that. And also, how can miners decarbonize their own operations? I've attached the reference there, and it'll be interesting to hear as we get into the Q&A how you think and reflect on what are those questions, and if there are any others that you have. So really, in summarizing and leaving it, this transition to net zero is for real and started. The mining sector has a vital role in engaging and dare I say leading as we transition to that low carbon net zero world. That transition must be board and senior executive led. The lens of scenarios and disclosures are already beginning to provide a valuable lens, both from us as a financial sector, but I would argue also from your perspective as a mining sector. Engagement is going to be key. The Center for Sustainable Leadership here in Cambridge just produced a really very good template about how those discussions around transition should be had. And I'll kind of, again, leave the link for you to look at. And this is all really bringing a big imperative that we need to think very differently around transition. And I'm actually now going to hand over to Andy, who's going to give you some very challenging and probing ideas about that whole idea of thinking differently. Andy, over to you.
Thank you very much, Alan. Share my screen here. Hello, everybody. So I really want to build on something that Alan has introduced here, which is that there's a two-sided problem here. The mining industry needs to decarbonize itself while also helping to decarbonize the world. And so that's really a logistics problem. What I would really like to focus on is the system idea, because if mining is the logistics tail for this incredible campaign that we have to undertake, then I think this logistics system needs to be quite responsive. And I want to really focus on is it responsive enough? What will be the demands that will require it to be more responsive, and what can we do about that? So let's first of all start with a quote. And anybody with military experience will tell you that tactics win battles, but logistics wins wars. We're really in a major campaign scenario here, in which mining is the logistics tail for the teeth of decarbonization. And so there's a very significant global responsibility sitting on the shoulders of the mining industry. And if we think about responsiveness, we think about timescales. I'd like to draw attention to timescales throughout my few minutes here. This graphic showed up a few years ago and had a very profound impact on me. It shows how fast we have to reduce emissions in order to stay within a carbon budget that is thought to be associated with a 1.5 degrees C temperature rise limit. And the really profound thing here is that all of the blue lines are already lost to us. We have already missed those opportunities. Not only that, the black line is also lost to us. And not only that, but 2 of the red lines are also lost to us. And so when you hear phrases like we have a 7-year carbon budget, it's a profound mistake to think we have 7 years to act, 7 years to make a decision. The longer we leave it, the steeper this curve gets. And really on a timescale of decades, which is very familiar to the mining industry, these lines are very steep indeed. And the question is, how fast can the mining business respond? There have been a couple of really good reports out of the IEA in the last month or so that have greatly elevated this conversation in the public domain. And Alan's already referred to one of them, which is the net zero path. This is the other one, which was on critical minerals. And they did some research on the timescales of from discovery to production for various minerals. And a lot of this, I think, is based on the work of Richard Shoddy, who has come up with some interesting conclusions. And one of the interesting things he's arrived at is that for most minerals, price doesn't have much impact on speed to market. There is something of an advantage in copper. When the price goes up, copper gets to market slightly faster. But you can see here that the average is still a very long time frame. If we put that in the IEA diagram that Alan showed us earlier, and if we look at where that 16-year lead time for copper sits, then an interesting thing emerges, that if a discovery that is made today is likely to come into production after the point where all new car sales are electric. So if you think about the ramp up to get to a situation where 100% of car sales are electric, and if you imagine that 1 ton of copper only gets you 12 electric cars, then this is a pretty significant problem. I think there's a mismatch here in timeframes that we need to pay close attention to. And just as a sidebar, for comparison, this is the time it took Tesla's Gigafactory to go from shovels in the ground to first product. It was just over a year. This was a factory that was built in Nevada, and it was built in a modular fashion so that they could start production with a small part of the factory in order to get going sooner. And the reason I raise that is because that's what's downstream in this logistics tail. It's the value chain that is taking these materials that we produce and turning them into products. And the question we might ask ourselves is, if they decide to go down a material substitution path, how quickly could they do that? compared to the 16 years it takes to discover and open a mine. I think there's quite a mismatch there. And in the sense that we have to do something about that, there's a compounding problem. In the military sense, a logistics tail is almost always outside the theater of operations. But in mining, you can see here the coincidence of copper mines and lithium mines with areas of high water stress. You know, in mining, the logistics tail is on the front line. Mining has to decarbonize itself and address all of these risks that Alan was talking about, while also equipping the world to decarbonize itself. So we need to think about how fast can we respond to these extraordinary demands that are likely to land on our shoulders. And in this regard, there's some very interesting work that has come from Rick Valenta's group at the University of Queensland in a program called Complex Ore Bodies. And what they've done is to look at the risks that might impede new supply coming to market from an ESG perspective. So they've done an analysis of the 300 largest copper bodies, in this case copper ore bodies in the world, or the 300 largest untapped reserves and resources of copper. And they've looked at what risks stand in the way of development of those reserves and resources. And what they've found is that the vast majority, in fact, about 96% of those ore bodies are constrained by at least one price insensitive risk. So we're talking about ESG risks that are not amenable, that will not simply go away because the price goes up. And 63% of them are constrained by at least 4 risks. So there are some pretty fundamental obstacles here or challenges in the ESG domain that are not price sensitive, that stand in the way of bringing supply quickly to market. And the question we have to ask ourselves is, what are we doing there to improve the responsiveness of this logistics system? So what I'd like to do is just go around a vicious circle that we've identified in Inspire Resources of how supply comes to market. So what systems thinkers do is look for the self-reinforcing positive feedback loops in order to try and find the best escape route where you can change the system for something different. And we think there's an interlocking sequence of factors here that I'll just walk quickly around. If you want to look at the slides when you download them, you'll find there's an explainer for each one, but I'm not going to go into that here. I'm just going to walk quickly around here in the interest of time. So I'll start at the top here with capital intensity. Everybody in mining says it's capital intensive. It's just an accepted thing that it's capital intensive. So that's both in the relative sense, so relative to labor intensity, but also in the absolute sense of the capital investment that is required in order to develop a mine. So if we start from this axiom that mining is capital intensive, we see that the shareholder primacy is a natural thing that follows from that, because development stage miners, their first preoccupation is investment attraction. And so they put on ties in order to meet with investors. You know, investors are in some ways the customers of mining. And that leads to a strong sense of shareholder primacy in the mining business. This need for investment attraction causes the design process for mines to effectively become a design process for investment attraction. And we go through a sequence of design stages that are really intended to identify risk. So it's designed for the purpose of removing uncertainty. So we go through a preliminary economic analysis, pre-feasibility study, feasibility study. These are design stages which have effectively become codified. You know, and securities regulation has helped to do this. It's sort of standardized the steps and the sequence so that everybody knows what they're looking at when and what it has to contain. This codification of the design process has made it easier for mining companies to outsource the design role. And so design is undertaken, these studies are undertaken by engineering companies usually in a contracted role out from mining companies. And of course, what happens then is mining companies' procurement people get involved, and then it becomes a commoditized design task because you have multiple engineering companies competing for the work. So it becomes neatly packaged as a transactional sort of task. And that packaging tends to reduce the appetite to consider complexity. And so as a result, when the economic models are put together, they're very much in a static framing. You know, it's a static NPV analysis with a number of fairly static assumptions about what the future holds. This static framing is really interesting because in engineering terms, it leads to an unassailable advantage for economy of scale as a design principle. So we end up with very large mines and processing plants in the pursuit of economy of scale. That leads us towards large projects, which are capital intensive. So you can see that the loop closes here and reinforces itself. And along the way, we tend to ascribe low value to small projects. And there's actually quite a lot of unintended consequences that arise from this. And the interesting thing about those consequences is they lead to lost opportunities in ESG. So they make it more difficult to incorporate community development and environmental protection goals into projects. So there's a whole set of causal relationships here that are making it difficult to address these ESG risks that the complex ore bodies work have shown us. And I would argue that this is the essence of what's slowing us down. That we're trying to deal with these positive outcomes that could have been available. We're treating them as risks instead. And so the vast majority of ESG work is really driven from a risk perspective at the moment. There's an interesting sidebar in this, which is the role of regulation. You know, we've worked that into our diagram as well. You have large projects creating high impact risks. You have a commoditized design task that's not adequately including stakeholders. You end up with tight regulatory scrutiny and control, which ultimately is making it harder to change the design process. So we think that there's this vicious circle, and that if we wanted to change the responsiveness of this system, we need to address it from a systems perspective and understand where to escape from this circle. So there's a sequence of conclusions in all of that. I've run through it quite quickly, but essentially mining is the logistics engine of decarbonization, and we have to equip the world to decarbonize itself while also decarbonizing mining. There's a mismatch in timescales. The speed with which we bring supply to market is not what the world needs for decarbonization. And I think that to accelerate, we have to innovate in ESG, not just avoid ESG risk, but actively innovate in ESG to create better outcomes so that we can accelerate. The incumbent business model inherently limits that speed and innovation because of the relationships that I've galloped through there. And I think the key point here is that this is an emergent characteristic of the system. It's not that any one player wants it to be this way. It's just that this is how it has emerged. And as any systems thinker will tell you, we can't really address this until we acknowledge that we're all part of it. So I think there are some ideas for discussion here. I'm very happy to be contacted if you want to take these discussions forward, but I think at that point I should stop sharing and hand over to Simona for Q&A.
All right. Thank you all for sending your questions. Thank you for the speakers as well. We wanted to have a good debate going, so if you can, please continue to write your questions in the chat or in the Q&A section, whichever is more convenient. We had already some questions from the audience, and I think it would be good to just go over them quickly. Andy and Alan, I hope that that's okay, even though I've seen that there's been some answers coming through. One of the questions that was asked was, how do you see the distribution of capital investments for the ESG agenda when we compare junior and mid-tier mining companies with senior mining companies? So I think this one is an interesting one. If either of you would like to address it.
Go ahead, Alan. You go first.
Okay, I think, and actually it links back to Andy's presentation just now, that increasingly capital is going to flow to where people have credible transition plans. So banks in particular, and also investors, want to work with clients to support them through the transition. But the key thing to that is having very credible transition plans. So even as Andy was describing his solutions there, that's what increasingly a credible transition plan will have to be incorporated in ideas like that. And I think it's going to actually be agnostic to size of company, but actually to who has a credible transition plan or otherwise. So that's how I would look at it.
Yeah, I think a lot will depend on where the capital is coming from, because different pools of capital value different things. And one of the things that we hope to do in Inspire Resources is to detoxify mining for impact investors. And that's a pretty tall order at the moment. You know, if you look at the spectrum of socially responsible investment, impact investment, which is actively seeking change, is a tiny fraction of that. It's maybe 2 or 3%. And the people who are doing that generally don't see mining as an ally in that effort. And the question we're asking is, well, how can we show up as an ally? And in order to unlock that investment in a way that makes projects go faster.
Very nice, thank you. There's been some more questions coming through, so I'll start asking the ones that haven't gotten an answer yet. One question was, I have thought about the investment attraction issue within mining and wondered if anyone has given thought to another system, such as a decentralized global board or some such thing that gets funding and then decides where to place the investment. It would be highly technical board with the goal of net zero 2050. This would be a massive change. Could this work? Maybe we can start with Andy this time.
I'm tempted to say no, but I think the problem with that is a societal and political problem, that technocratic leadership and global government are like touch papers in the fireworks of politics. And you know, the idea of governments picking winners is a strong threat to a lot of governments, and the idea of supranational authorities deciding on resource development is extremely tricky. Now, there are some opponents of mining who think that that's what the World Bank's already doing, but nonetheless, I'd say that politically it's extremely difficult to imagine how you can centralize the decision making for issues that cross so many ESG and political and economic domains as mining does.
All right, thank you. There's another question. I have thought about the investment attraction issue, all right. How do you propose to address the ever-growing challenge mining faces in virtually every jurisdiction in building and maintaining a social license to operate, especially in light of the water stresses and other ecosystem services impacts? Maybe Alan, would you like to take this one?
And again, it's almost going back to what I was saying, is kind of engaging proactively around those transition plans, of having a credible transition plan. I think one of the things, again, going back to that IEA report, mining is going to have to be part of the solution to get to a net zero world. You know, and even as they say that significant demand around the metal, the mining in support of transition, and I think society will realize that. I think the key thing is engaging around exactly those aspects. How do you have a transition plan and credible transition plans which are conscious of net zero, but actually conscious of the natural environment and biodiversity in ways which are so integrated with the mining sector. And again, this is where Andy's model and ideas are so powerful, because those are solutions which are more agile but bring it around in a more integrated way. And I think it's having plans which are articulating solutions in that way will be where the kind of social and economic license comes from.
Excellent. Any additional thoughts, Andy?
Plenty, yes, and they're all on our website. But what I would say is we really have to think about the design process. You know, so design is a process that creates an artifact that has value, and the question is, to whom does it have value? You know, when you create the artifact that is a mine, for whom are you trying to create value, really? And recognize that you're doing that all the way through these PEA and PFS and feasibility study stages. You know, to what extent are we involving all of the stakeholders in the design process? I think that we can make a huge change to the design process that would be seen to be a lot more valuable by the right kind of investors who are looking beyond just NPV and IRR. You know, there's plenty of opportunity there to change how we design mines and for whom.
Fantastic. There's another question that came from Lalit. Many developing countries have heavily invested. Just one second, I lost here. Have heavily invested into power plants based on thermal coal, so it would be a slower transition, possibly would take decades. Any thoughts to that?
I think, Lalit, you've hit on an issue which is central, sensitive, but one which needs to be grappled with up front in a very responsible way. In that, obviously, from an emissions perspective, thermal coal is, you know, kind of one of the highest emissions and one of the ones that needs to be addressed quite urgently when it comes to looking at the transition. And we're actually, many stakeholders from an investment perspective are putting pressure. At the same time, that transition has to be responsible for exactly that reason that you said, that many developing countries, India is one, South Africa in particular is another one, so much of their energy is fueled by that. Where you're already beginning to see is differentiation of the time by which people are having to kind of transition from coal from in developed economies that against developing. So there's a recognition of that. But there is also, and even earlier this week, a lot of discussion on the realization that it needs to be a responsible transition for those emerging economies that are so dependent on coal, and it's playing out. So you're right, Lala. It's actually one of the most immediate questions that everyone is grappling with regards to thermal coal, but it's one which can't be ducked, but one which has to be addressed in a very responsible way.
All right, Andy, if you don't have something, do you have something to add to this, or should we move on to the next question?
The only thing I would add quickly is what sunk cost stranded asset risks are we creating today? You know, so some are already in place, some are already sunk cost problems that we have to amortize away over a long period of time. What new stranded asset risks are we creating today, and what questions are we asking about major projects in view of potential future changing circumstances? I don't think we're paying enough attention to that.
All right. Henrik has a question. It appears to me that recycling on a very significant scale is going to be the only way to match the metal requirements with the long mine development times. Thoughts to that? Maybe we'll start with Andy this time.
Yeah, I can't see how we would get there without significant increases in recycling, you know, and it surprises me how immature in North America the circular economy discussion is compared to Europe. You know, it's been an obsession of the European Union for a long time now, and yet it's a completely new thing here. That really surprises me. We've got to move a lot faster on that.
Alan?
No, nothing to add. Not to add. I think that covers it off well.
Anne said, is it more practical to make complicated changes to mine operations to suit certain major finance providers, or instead to develop along the most logical track and seek those niche investors that remain interested?
Well, that sounds like it's born of experience. You know, I think the point here is that the investor is a stakeholder in your design process. And that if you are treating the design process as a transactional thing, like you're going to print out the documents and deliver them on a forklift truck to the regulators and the investors at the end of $1 million project with an engineering company, well, you know, that's not going to work in the current age. It needs to be a lot more interactive, the design process.
Yeah. And to add to that, and to answer your question, I think the key thing, Anne, is it's not so much to suit major finance providers. That to Andy's point, I think it genuinely has to be collaborative. We have genuinely changed, in my view, reached an inflection point where the expectations of investors, the expectations of society and of stakeholders require that we are addressing the issues. But that also, I think, from a mining sector perspective, or from any of the transition sectors, is that realization that the sector is and has to be part of the solution. And again, having something which is just there to meet a finance need without having that net zero focus at the end is not going to work. But again, it's where working collaboratively with your financiers, and financiers working very collaboratively with clients to come up with the, as I said, the credible transition plans is where the game is going to be at, in my view.
Right, and then the next question we have is, how would you suggest the world change the problem of the investment attraction and interrupt this vicious cycle? I know that this was a question that Andy posed, so maybe you can.
Yeah, can I just share a slide on that?
Sure.
So there's a really good piece of work by Donella Meadows. She was one of the leading thinkers in systems thinking, wrote an excellent book called Thinking in Systems. And she came up with a priority order list of how to escape from the vicious circle. And she suggested that in this order, you can have effect. So the 12th most effective thing to do is to change parameters or numbers. And the most effective thing to do is to think outside the paradigm and think across the paradigms. And so what we've noticed is that the industry is working hard on items 12 to 5 and is trying to climb up to 5, particularly around 6. There's a lot of value chain optimization work going on the 6th most effective thing to do there. But what we found was that there was almost nothing going on in priorities 1 to 4. And so that's really what we've set ourselves to. So as a general principle, a systems thinker looks for the best place to escape from the vicious circle in this order of preference. And again, I think we have some solutions to that, but it primarily involves the relationship with investors. And the fastest way to do that is the way that Paul Polman did it in 2009, which is just target the investors who look like the future you want.
All right, Alan, any thoughts to this, or shall we move on?
Yeah, let's move on. I think Andy's covered that perfectly.
perfect. The next one is, there are so many guidelines and requirements to follow when companies need to report the ESG metrics, I guess, such as from sustainability and Sustainalytics and others. Do we have standardized set of requirements that companies can track and report?
Not as yet. So obviously you have people like Sustainalytics, you have the MSCI ESG rating assessments. You're increasingly finding a number of the big rating agencies beginning to have ESG assessments. That is one of the challenges, that there's still not standardized ESG reporting. And I know we have some of the accounting standard setters and people like the SASB in the States who are beginning to go in that direction. I think the important thing there, though, is even as we're moving and hopefully to get some degree of standardization, that a firm's ESG rating is actually going to become as important a rating to have respect for and consider as its credit rating. I think we're moving in that direction, and that even as we wait for standardization, we should also be reflecting the fact that ESG ratings are becoming increasingly a lot more important.
Thank you. Andy, anything to add, or shall we move on?
Only that checklists represent a floor, not a ceiling.
Indeed.
That makes sense. Sarah, in Canada, is equity partnership with Indigenous Canadians critical to expediting sustainable mining? What institutional barriers are in the way if this is the case?
Shall I take this? This is a topic very close to our heart, and it is one potential route to going faster, because sufficient equity involvement could be seen as a proxy for free, prior, and informed consent. And so there are many reasons why you would want to do this, and we certainly are heading down that path. With the idea of the community being the customer for mining as a service. So there are many barriers, particularly access to capital. And there's a fair bit of work going on there. There's a significant increase of conversation around this following the conference of the First Nations Major Projects Coalition earlier this year, which was a remarkable thing. 1,500 delegates attended that. Mark Carney was the keynote. It was really heralded a significant upshift in this conversation. So I think it's potentially very helpful in some projects, probably not all, but it's one way in which we could change the system.
Okay. I would actually ask whether you think that there's something equivalent outside of the Canadian context, either Alan or Andy, whether you're familiar with anything that, you know, goes beyond just the Indigenous Canadians situation.
I think most definitely, because the whole idea of having a just and equitable transition is actually at the key and the core of the climate change transition, because invariably communities who historically have contributed least to the emissions problem are those who are most vulnerable or are suffering the most. So I think that principle and that engagement that Andy has talked of in the Canadian context is going to be, I think, a principle that is going to have to be reflected across many jurisdictions. And actually, there's a very live and real case going back a couple of months in the context of Australia of a kind of a major global mining company in terms of how they did not engage properly with kind of the Aboriginal communities in Australia at great cost to themselves financially from a reputational perspective, and actually in terms of the careers of their senior management. So it's showing that partnership with Indigenous communities, First Nation communities, is a principle which I think will apply beyond just Canada.
Excellent. Thank you so much.
It's probably worth also noting the extent to which community ownership of projects has become pervasive in renewable energy. You know, there are now 4,000 projects worldwide, renewable energy projects that are community owned. And so, you know, this is indigenous communities are one kind of community, but the idea of community ownership can be enabled if you change the system architecture. You know, that's what happened in electricity. And that enables participation, enables things to move faster.
Oh, fantastic. Another question, are financial institutions such as HSBC giving more favorable terms to mining companies in the future facing commodities and proposing net zero enterprises?
We're at the stage that much of the industry it is pivoting its qualitative risk appetite around to people who are in renewables, who are doing, you know, transition to the green economy, and obviously making those in the context of credit evaluations even from now. One of the interesting things which is coming up is that people are realizing that managing the risks to net zero are quite distinct from managing climate-related financial risks. So even at this stage, you're having to weigh up those two things. Those discussions are going to become increasingly more quantitative and will be reflected, I think, over time in pricing. You know, but there are definitely qualitative assessments. What is fascinating as an aside to that to that question, and Andy and I were talking about it earlier, here in the United Kingdom, the Bank of England has a kind of central bank corporate bond buying program. And what was very interesting, just last week, they issued a consultation paper where, and put it out to the industry, so it's not policy as yet, but where they've indicated that they will start considering the greenness and the transition readiness and commitment of the underlying corporates as one of the factors that they begin to signal in how they think about you know, the corporate bond buying programs. It's still, as I said, a consultation paper rather than policy. But if you think about that, it actually plays exactly through to that question that was just posed to us, and that's the central bank of the country, in turn, because they themselves are having net zero written into their mandate.
Anything to add to that, Andy?
Nope.
All right. So Carlos asked, talking about a paradigm shift, do you see a role for nuclear and hence uranium mining in the net zero transition?
I see a role for almost everything in the net zero transition. You know, if you look at that slide from the IEA, it's like all hands to the pumps. It's everything. And the only way I could see a large scale reduction in the role of nuclear is if we can significantly decouple energy consumption from GDP. And that is even embedded into the existing IEA scenario in a way that's never been demonstrated to be possible. So I think just from an energy density perspective, nuclear has to continue to have a role. Whether small modular nuclear will work is an interesting question. I'm not convinced myself, but it's an interesting question. But I think that nuclear power will continue to play a very significant role in the jurisdictions that have it.
And Andy or Alan?
No, nothing more to add on nuclear. Nothing.
All right. So what is the panel's view on companies like Onion Corporation, a technology startup that is providing ESG reporting software? Ooh, who should tackle this one first?
I don't know about Onion specifically, so I wouldn't comment on it. What I would say that data and analytics is at the core as to whether we're going to be successful in identifying and managing ESG risks. So to the extent that, because it's bringing in a whole set of data series and data sets which have not been gathered in the, or needed to be gathered in the way. So if you think of emissions which need to be then translated into to an alignment to some kind of temperature alignment, whether it's physical, geophysical location, and which again needs to be translated into this kind of physical transition score, or whether, and those are kind of just the E within the ESG, far less thinking about water stress and how you then try to bring that into some kind of financial risk type equivalent basis. All of it is requiring data MI software solutions. So anything that is addressing that and or has the potential to address that is going to be something that people are going to have to look at, because it's one of the biggest challenges that's out there.
And Alan, just to jump in here, won't that have also a big contributing factor from actually having the standards set much more defined and much more concretely?
It is, and also that if you look at, say, one of the bodies, PCAF, that is driving a lot of the kind of greater standardization and disclosure around accounting treatments. One of the things which PCAF is also requiring as people begin to disclose is actually saying almost you have a health warning that from the outset you kind of disclose and say, well, this data is based on incomplete data. This analysis here is based on incomplete data. So actually, even from the outset, beginning saying, well, that, you know, data is a challenge, but it's not an excuse, you know, because we can't wait till we've got perfect data to start writing or disclosing it. But actually in the disclosure frameworks and in what we actually disclose are very transparent about how limited we may be at this stage. So, and again, so if you have a look at PCAF and what they're talking about, it speaks to exactly that point that you brought up, Simona.
Thank you. And Andy?
Yeah, transparency isn't going to reduce. And, you know, there's going to be a whole ecosystem of products and services to support it. What I would say, though, is maybe this is a transitional phase. You know, if you think about manufacturing and quality control, when quality first became a thing, customers were measuring every product as it was delivered to make sure it was of the right quality. And eventually, we figured out that quality assurance was a better approach, so that you didn't have to measure everything. Rather, you had assurance that the right kind of systems were in place. And I just wonder whether eventually we will migrate to something that is much more efficient for all of us to use, that's based on assurance rather than compliance. It's an open question. I'd like to think that will happen, because otherwise we'll just drown in the alphabet soup.
The next question is the need for electric motors more in EVs or material transport systems such as aggregate conveyors? Ooh, I would like to tackle probably Andy first.
Yeah, I think the need for electric motors is in everything. So to decarbonize, we have to electrify everything. It's as simple as that. Even heating systems, you know, they have to become electric motors, heat pumps, in other words. So yeah, I would say it's everywhere.
Alan, anything to add to this one?
Nothing other than this, to re-emphasize what Andy says, that the move to electric is going to be all pervasive. And again, this is where the IEA report and brings that out in quite powerful ways.
So the next one is, the Paris Agreement was signed in 2007. Why is this only now becoming a global priority? Ooh,
well,
timing.
First, the Paris Accord was signed in 2015, so not 2007. But actually in itself was quite revolutionary, not just in terms of the number of signatories, but that also because of the way in which it kind of drove the concept of nationally determined contribution. So it was almost more bottom up. Prior to that, with some of the earlier accords, it was almost a top-down allocation, which got mired in political and other trade-offs, and so actually never went as far as it went to. The Paris Accord kind of said, okay, each nation has to come up with its nationally determined contributions, but then through all of these extra things of disclosure and the kind of increased regulatory and monitoring kind of mechanisms, people will continue to be challenged to make sure that, one, people are meeting those nationally determined contributions, and that actually those nationally determined contributions have that sense of urgency and fairness and equity, so that what you're finding now, and actually even where the kind of COP26 that's going to be held in Glasgow in the UK later this year, is actually one to kind of re-emphasize and push further on the Paris Accord. The other aspect too is actually to really embed the 1.5 degrees. So Paris was getting to below 2 degrees, but there's now a greater urgency of getting to net zero and to 1.5 degrees. So while it was not 2007, it was 2015. What we're seeing now is the greater urgency to kind of continue to embed what Paris started.
Right. Andy, any thoughts to this?
I think the question why have we failed to act is a good one, but it's not really a good one unless we figure out how to do something different. I'm not sure that there's a dramatic silver bullet solution to that, but it's really I think progress will depend on the proportion of the ecosystem that gets the sense of urgency. And if we get the sense of urgency, we will take action, we'll take risk, we'll figure out how to collaborate, and ultimately we'll make progress. Will it be fast enough? Well, it has to be. And if we don't force ourselves into that mindset, I'm not sure that any of this was worth doing. Really, like we've got to win, and we've got to collaborate to win, and we've got to each play a role in that.
This is a question, I guess, from us as panelists in the discussion. Whether you have any thoughts around, the developed world has had a chance to develop without all of these standards in place, and how do you think it's going to be impacting the developing world, the fact that now there's stricter and stricter standards while they are going through the development stage? Any thoughts to that?
I think there is going to, it has to be addressed. In the long term, climate is going to be no respecter of persons, as I kind of engaged with somebody recently. In the short term, sadly, the impact is disproportional and inequitable. When we talk about a 1.5 degree average rise, actually that isn't going to be happening equitably. It's actually going to be happening in a lot of those countries, in the tropics, that are already quite vulnerable. Okay, it's already also going to be disproportionately impacting communities of color, women in particular in the global south disproportionately, and that's what the data is showing. But we ignore that at our own peril, because it's ultimately going to get to us, because we can't, the global climate system is the global climate system, and so I think it's pushing, and we're already beginning to see some of those issues come into the fore, about giving the emerging markets and the global south the ability to adapt, but even there, is one of the challenges. Back in 2009, we committed to give 100 billion a year to provide in finance to support, to help emerging markets do that transition, and we still haven't got anywhere to that, near next to that number. So it's actually a really big and important question, Simona, but I think one that we have to address. In particular, you know, going back to Lalit's question earlier about the transition away from coal and thermal coal in emerging markets. That's one of the areas where you can be kind of, as those economies who are emerging and who are using thermal coal disproportionately, you can't kind of go and say, you know, you can't do that. So some really important challenging questions, but I guess also opportunities, because it's where investment needs to happen within those economies to help them with the transition.
Andy?
Yeah, there's also a mining industry specific perspective on this. Some of the harshest critics of the mining industry believe that mining is going to use the green transition to create sacrificial zones in the world. That's the language they use. And we need to be very alive to that kind of thinking. And we need to be very, very sure that that's not what we actually end up creating. You know, and so this ESG impacts of increased mineral production is going to be an extremely important topic. And if we create, you know, if that prophecy comes true, and if we do indeed create sacrificial zones, how on earth can we call that a just transition in which, you know, we've played a valued role? That's we really have to avoid letting the market drive increased adverse impact in poor countries in order to decarbonize rich countries. That would be a really bad outcome.
Yeah, for sure. And another thought from us was, we were talking about investors and whether they realize that they are part of the bigger problem, and what's your suggestion in terms of the focus? You know, if we're to move away from the NPV conversation, what should the new focus be?
You want to take that one first, Alan?
I mean, I think it's actually becoming a really sensitive part of the conversation, but at least the conversation is beginning to happen, because as investors, whether it's kind of big fund managers that own you know, big listed companies, they are, as they're posing those questions, I think there's also the ability to have a much more grown-up discussion around returns and risks in a much more informed way. But that trade-off that I was saying is coming very much to the fore, that managing the transition to net zero is very different to managing the immediate climate financial risks, becoming a really important consideration. And also where we're having increasingly to have those grown-up discussions, what degree of trade-off of returns are you prepared to accept, you know, in this period of transition? And again, a lot of it is going to be coming back around what is the underlying cost of capital, and how as we go through the transition, how is that going to be impacting cost of equity? Because obviously it's one discussion to have which says we're happy to have a slightly lower return in this transition period once it's still above your cost of equity. It's another one to say, you know, we're having this discussion and you're not covering your cost of equity. And I think increasingly having the data so that discussion becomes a real and transparent one is going to become very important.
Andy?
Yeah, I think you know, there's going to be a difference between investors who want to avoid risk and avoid being associated with bad things. That's going to define the floor, and the ceiling is investors who want to make change. And it seems to me that there's a whole spectrum in between. And mining really targets a very small segment of that today. It's become a very special interest sort of investment product. If you look at the number of if you look at the range, you know, look at the PDAC report on mining finance, they identify that the investors in mining are somewhat specialized these days. There's not so much in the way of generalist and retail investors in mining. And my question is, how can we broaden that appeal? If we think that investors are perhaps the customers of mining, how do we find new markets, new customers, new markets who want to have different impacts, and then tee up those impacts? Because mining has the power to do that. It's not just mining, it's electricity, it's water, it's agriculture, it's community, it's remote locations, it's economic development, it's all of these things, and you can easily create business models for markets of investors who care about those impacts.
Yeah, and of course, when we're thinking about this, if the funding disappears, there will be a cost to the economy overall as well. So, that will have an impact. From your perspectives, how engaged and how prepared do you feel that the mining companies are, for this transition? And from everything that you've seen and anything that you've come across, how solid are the transition plans that they are putting forward?
I think one of the key things is that you're beginning to see the sector engage, and if you look at their disclosures, you're beginning to see them talking about the net zero transition in many ways. Even if you go back to that example that I gave from our disclosure extracts earlier, it shows a number of the mining sector is actually engaging, and their boards are engaging around it. So the journey is definitely starting.
Yeah, I haven't spent much time in the compliance zone, and I know that a lot of work is going on there, and there's a major shift in ESG compliance. The question for me is, to what extent are mining companies adopting a broader sense of purpose? And we see that it's kind of a stack. There's a fairly large layer that has it in communications. And then there's a smaller layer that has it in strategy. And then there's a layer that has it in business model, which as far as we can tell is just us. So, the reason we started Inspire Resources as a new company was because we think you have to take purpose all the way to business model in order to be real. And so what I see is a lot of purpose showing up in strategy and communications. And the question is, to what extent will the talk be walked? And there will be leaders in that, and there will be laggards in that. We would like to be among the leaders, and we would like there to be other leaders too.
Right, well, thank you so much. Such a suggestion came up here just now from one on the panel saying that, the audience is welcome to share with us their thinking by email. Happy to hear that. I believe you can follow up with the speakers as well. Both Alan and Andy are available. You've seen some of the contact information, and for sure Alan is available on LinkedIn, Andy as well. And I think Andy provided an email address, so please feel free to reach out. Lots of questions raised today. Clearly, there's been some progress. We have a long way to go, and we've had a good sense of the urgency that's required around this. There's need for planning, process, transparency, communication is key, engagement. So a lot of work for the mining industry to do, and for partnerships to develop outside of the mining industry as well. That's important to come to an overall solution here. So I'd like to thank both Alan and Andy very much, and Crystal for your input as well, and Simona for kind of guiding us through the Q&A. And thanks to everyone who joined us. And we look forward to seeing you at our next discussion group meeting. We will hold one in June as well. So look for that. And again, thanks for everyone for your time and input and your great insights. Thanks, and that's the end of today's discussion group meeting.
Thank you very much.
Thank you. Thank you.